I start recording.
Hello, everyone. Welcome to the ADP workshop. I'm Ziting Chu from Norwegian School of Economics. So I'm the moderator for today's workshop. And our presenter is Kalash Jain from Columbia University. And he will present his paper titled Evaluating Nature of Expense Classifications, Evidence from Labor Costs. During his presentation, if you have any questions or comments, please use the raise hand function or type in the chat box. And when I call on your name, you can then unmute and speak. Otherwise, please remain mute during the whole presentation. Yeah, and we also encourage you to have your video on so that we can see each other. And for the first 5 minutes of the presentation, we will have no interruptions. So please hold on your questions or comments until the first 5 minutes have passed. Yeah, and Kalash, when it's 5 minutes left for your presentation, I will give you a reminder so that you can prepare to wrap up. All right, so now the floor is yours.
Thank you, Tusing. And thank you, Ayung and Stephen, for organizing the ADP seminar series and for including our paper. This is joint work with Yue Chen, who's at Chinese U of Hong Kong, Nan Li at Toronto, and Shiva Rajgopal, who's here at CBS with me. Yes, so the paper is called Evaluating Nature of Expense Classifications, Evidence from Labor Costs. So the motivation for the paper, I'm sure many of you are aware, FASB currently has a proposal out for the disaggregation of income statement expenses. It's been out for many years now, and it's quite a departure from what we traditionally think of as US GAAP financial reporting for income statement expenses. So to put some terminology on this, usually income statements are disaggregated by the function of expenses. So what that means is they're disaggregated based on the purpose or activity in the business. So the classic example here is COGS and SG&A. But you can also disaggregate based on the nature of expense basis. So this you can think of as more like the production function that we think of in a macro class. So you disaggregate based on the economic resource that's being consumed. So the example here would be wages or labor, depreciation, or materials. And obviously you can do both of these together. So you can first disaggregate by function, and then within that in a nested fashion, you can disaggregate on a nature of expense basis. And that is what this new reporting convention that they're proposing in the latest DICE proposal, they're suggesting that there's some form of nested disaggregation that should occur. Now, we focus on the labor side of this, on employee expenses specifically. To give you some understanding of why we want to focus on employee expenses, I have a few quotes here. I think we've all heard this before, right? Employees are a company's greatest asset. I've heard it so much, I didn't even know who said it first. So I went through a Google rabbit hole to try to figure out who said it. And I think this person, Anne Mulcahy, the former CEO and chairwoman of Xerox, said it. It's a bit ironic given where Xerox is today that she said that these are our competitive advantage. Clearly something happened between 2003 and now. But this idea that employees are driving a company's competitive advantage and their production is not only from the past 20 years. You can go back many hundreds of years. So Andrew Carnegie in the 1800s said, take away my people, but leave my factories, and grass will grow on my factory floor. But take away my factories and leave my people, and I'll have soon a new and better factory. So the idea that employees are a first order determinant of value creation has been around for hundreds of years. Yet, when you look at the financial statements, we don't really see much on human capital or employee expenses. So given this, we focus on labor costs. They're critically important, but they're notably absent from US GAAP financial reporting. And obviously, we know that there's a rising importance of human capital in the modern world. We've gone from companies like Standard Oil to Apple, Microsoft, Google, IBM, et cetera. And these companies seem to be valued very differently than the old hard asset companies. From an ADP perspective, we can directly comment on this FASB proposal. It is in final stages, but it hasn't been passed yet. And so we can provide some, I don't want to go too strong and say normative commentary, but we can provide some commentary on things we feel the proposal has done well, and maybe some places where they can go a little bit farther. So we feel this is directly in the spirit of the accounting design project to try to differentiate good accounting from bad accounting. So now to give you a research question, we've studied these employee compensation costs, and we see, are they decision useful for people in the capital market? So the idea here is we're going to test what are the consequences of disclosing these labor costs, And is there any difference in decision usefulness between aggregate labor cost and some disaggregated form of labor cost? And I'll explicitly define what we mean by disaggregation later in the presentation. So I think that's all the time I need, and I'm happy to open it up to questions. And if we don't have any, choosing I'm not being able to look at the chat, but if you see anything in the chat, just let me know. I'll keep
Sure,
going.
I will let you know when there's anything going on in the
Okay,
chat.
that sounds
Someone
good.
raised their hand.
So to give you an example of what FASB is proposing, we pulled an example from their proposal from 2023. And we pulled the services example. They also had an example for manufacturing, but you'll see that the services example is a little bit more relevant from a labor perspective. So here is an example income statement. And you see that the expenses they've disaggregated are in cost of sales, or COGS, SG&A, R&D, and D&A. So I think this is a pretty typical income statement that you'd see today. And what the proposal suggests is for every line item of expenses you disclose on the face of the income statement, so for COGS, SG&A, and R&D, you have to, within those categories, within those functions, you have to disclose employee compensation. So in the footnotes, what you'd see is something like this, where for cost of sales, you'd see compensation and termination benefits separated. And you'd see the same thing for SG&A and for R&D. So you'd get a measure of COGS wages, SG&A wages, and R&D wages. Now, they also have some focus on inventory disaggregation and D&A disaggregation. But again, like I said, that's more applicable to the manufacturing companies. And for our purposes of employee compensation, I think this gives you a pretty clear idea of the kind of information we can expect once this rule has been passed. Now, the rule has been around for a while, for many years at this point. And so in the intervening years, we've seen a lot of comment letters come from corporates, mostly pushing back on the regulation. So there are some companies like Apple that don't really have any pushbacks. They're fine with the proposed changes and agree that it'll enhance transparency and they'll be decision useful. But then there are companies like Starbucks, and Starbucks basically has released a laundry list of all the classic disclosure arguments we make in our research. So they claim that one, it's hard to compare this across companies, so there will be difficulty in comparability. It'll be complex to process. It'll be time consuming and costly to put together. They don't believe management uses this, so it's not clear it's actually relevant. It's not clear investors really need this. So they question things both on the benefit side to investors and on the cost side to actually putting this information together. Now, obviously, this is clearly a very legalese laundry list type argument. But if we go into some other arguments, we can see specific issues that companies raise related to their business model. So Pfizer, which is a pharmaceutical drug discovery company, claims that this disclosure requirement will not achieve comparability because R&D in pharma can either be done through outsourcing, where you outsource a lot of the clinical research to a contract research organization, or it can be done internally. And trying to compare these two sets of businesses within pharma will create a lack of comparability when you try to disaggregate into compensation expense, rent, etc. Cigna, which is a health insurance company, says that they've never heard of any investor or analyst asking for this information. So they're attacking the benefit side of things. Both Pfizer and Cigna are saying that they don't think this would be beneficial due to a lack of comparability and the fact that no one has asked for this. Marathon, again, brings up outsourcing because in the energy industry, you can use contractor work. And Boeing says because we build planes over many years, trying to determine these natural expense categories for single years will be very difficult, and it'll be hard to determine this. And so we don't think it'll be useful to investors. So to summarize, there are many, many comment letters. So that was just a quick overview of some pushback we've seen. But the idea here is that investors, or the corporates, are questioning the benefits of this information to investors. They don't think the disaggregation is useful. They don't think it'll be comparable. They don't think investors have asked for this information, and they don't think managers use this information. Some people like Starbucks have also raised concerns on cost. They think they'll have to change their internal systems to report this, and they think there are practical challenges of creating these categories. We want to emphasize that we can only answer the benefit side of this pushback. We don't really know how much it would cost to implement this, but the economic null that these comment letters are generating is that this information is not useful to investors and therefore should not matter to fundamental analysis. And if that's the case, whatever tests we run in this, I think that generates a very natural null hypothesis that this stuff is not going to be useful. Stephen.
Let me see.
Yeah, Kalash,
Yes.
what do the FASB or the regulators say are the benefits? I mean, what's the argument for the benefits?
So they believe that
you're going to push back with some empirical results. So what is the pushback? And are there investors who say they want this information?
Yeah, so we didn't really focus on that when we were doing the comment letter categorization, because we wanted to establish the tension here. But you're right. The FASB thinks that this will provide information to investors because it would actually give you information on how the production function works, right? If you think about how we think about things in macro, we think of a Cobb-Douglas function. We think about how labor and materials and all affect outputs. And right now, the way that the income statement is set up, we don't get that basic Econ 101 type flavor. And so I think the FASB's argument is we need some of that information, but the functional expenses are also useful. So let's nest these two disaggregations together so that we can pick apart what we want. Young?
I just have a quick comment on the comparability pushback on the benefit, right? Because that applies to inventory accounting as well, right? It's not just limited to employee compensation. That company can outsource their manufacturing elsewhere. So I don't think that is a unique kind of like weakness of this proposal.
So your comment is that these weaknesses would apply equally to employees and inventory?
Yes.
Oh, I completely agree.
And then we have inventory in the balance sheet for outsourcing firms. We don't have that inventory, right? So that has been there for decades. It's not.
That's a good point. That's a good point. Yeah, and we can bring that up. The reason we didn't, they do have some changes that they're making on inventory expensing as a result of this proposal, but we don't really touch that because our focus is entirely on labor costs. But I agree with you that this tension that they're bringing up would apply equally to inventory. Jain.
Aloha, Kalash. What prompted FASB to take on this project if it's kind of like no investor demand or something like that?
Well, we selected these comment letters to show that corporates are claiming that there is no investor demand. But notice, I don't have Vanguard or State Street or BlackRock telling me this, right? This is Starbucks and Boeing and Marathon saying this. So it's not clear that there is no investor demand. That's just the argument that these corporates are making.
Oh, okay.
Yeah.
So do you have some anecdotal evidence showing that analysts are kind of like demanding or using this information? Or
yeah, so we can add that into the paper. Currently, we were trying to establish the tension, so we were focusing on the pushback, but we can definitely add some idea from like a Vanguard or a BlackRock or something, saying that they would find this information useful. But this is a natural tension, right? The corporates don't want to disclose this because it's costly to them, and the investors want as much information as they can get because they're not the ones incurring the cost. Maybe indirectly as a shareholder they are, but they always want more information.
Or also, do you think the benefit will be kind of like industry specific? Maybe they, in some industries maybe more benefit, maybe some other industry less benefit.
I see. Yeah, so we can provide some anecdotal evidence of and empirical evidence. Currently, we don't do a lot by segmenting by industry. If anything, we throw out that variation with our fixed effects, but we can do more on that for sure.
Yeah, I think you don't read about in the Wall Street Journal. I never heard investors asking for it. You don't read about in the Wall Street Journal or Financial Times that we really need this information. So if you could get something to really get this going, I think that'd be very helpful.
Okay, thanks, Stephen. We will do that.
Oh.
Yeah, two questions. One, Kalash, in the full implementation, are you talking about like a 4x4 grid where there now be 16 categories? That just seems like it seems like information overload.
I hear you. Yeah, so I don't think it will be that extensive. If I can go back to the example, I think what you'll have your normal income statement, and this won't change much. But in the footnotes, you'll have some additional nesting where for each line, like for cost of sales, you'll have a few lines. For SG&A, you'll have a few lines. For R&D, you'll have a few lines. So yes, there you will go from, let's call it 3 line items to 9 line items. And so, yeah, I mean, there is some element of like exponential growth in line items here, but hopefully by virtue of it being in the footnotes, we can alleviate some of this information processing cost. But honestly, we can't really speak to that in this paper because it hasn't been implemented yet. So a big motivation, yeah.
It doesn't exist anywhere?
So we have to estimate these employee compensation measures with private data. So that, and I'll talk about what we're doing here, but this is a big motivation of our paper, that it's important for us to provide ex ante evidence for the FASB. We can't only wait for them to pass a law and then say, was it good or bad?
No,
we're trying to give it, yeah.
When you say estimate, are your estimates, accurate, or they're, okay, so if you say that R&D labor is 20,225, that's the number.
No, I can't say it with that accuracy. We do some validation tests, and all we want to show is that we have some incrementally useful information relative to what we have right now. And there are some existing measures in the literature that try to estimate this employee compensation. But we show that what we can do with our new data sets can push it forward a little bit. But I'm never going to say that I can get 20,225 exactly. And I run some validation tests, so I'll show you what I do in 15 minutes or so.
So Dipta, do you want to ask your question? I saw you type something in the chat.
So it seems to me that Compustat, for example, can get some of this data. For example, Compustat reports COGS excluding depreciation and amortization, which is part of what the FASB is proposing. But so is this a general phenomenon that the credit rating agencies can get all this detailed information already? Because companies report COGS including depreciation and amortization, but Compustat undoes that and combines all the depreciation and amortization already. So are there other intermediaries doing the same thing with the labor costs or other components, for example?
Yeah, that's a good question. So the way Compustat and DNA works is they're taking the cash flow statement and they're using that cash flow statement number to separate it from the income statement number, even if it's not disclosed explicitly on the income statement. And you see similar things with Compustat and R&D, where they pull R&D out of SG&A because R&D is required to be disclosed, even if it's not on the face of the income statement. So things like that are occurring. But for employee compensation, there isn't that kind of tool out there. You couldn't, piece it together from the 10K unless the firm is voluntarily disclosing employee compensation, which does occur, but it's a very select sample. And I'll talk a little bit about what we do have from Compustat and what we don't have from Compustat to motivate our new measure.
Brett?
I was interested in the Starbucks example. You said the comment was there's kind of a disconnect between what is proposed or to be required and how the company manages things internally, kind of disconnect with the management approach. And I wonder if part of that is instead, this is the way we've always done it, right? We do it first by function, and now they're proposing this additional layer of nature. But if it were flipped around, if nature came first, saying, okay, here's our wage, our human capital expense, and then how am I allocating my people, right, to R&D projects versus production and so on, would that be more aligned with how managers think of this internally? Not that it's a different information, it's just how it's being presented.
Yeah, so you're arguing that there's some path dependence here, that managers go to MBA programs and are trained in this way, and so that's why they think it's not useful. I think that's interesting. I mean, obviously it's hard to test that counterfactual, but I agree with you that in and of itself, it's not clear to me that nature of expense is useless and function of expense is useful. Both seem to have pros and cons. And so it makes sense to me that you'd want both, but maybe we can add some of that anecdotally, at least in our writing. I think I'll take 1 or 2 more questions and then I'll move on. So Agnes?
Yeah, okay, I'll ask quickly. And that your paper says that you're interested in this disclosure on decision usefulness. And then you're finding a lot of those are kind of related from the investor perspective. And I just keep thinking about that decision useful. What type of decision this will be useful for? And for example, is that does the company pay too much wages, or like the productivity is less, or they pay a lot of wages, try to attract talent? And so this kind of decision that, I mean, this kind of information can help us, investor to evaluate. So I was just kind of, wondering if you could be more clear about what type of decision this information will be useful.
Yeah, thank you for that comment. I agree with you. Decision usefulness is a very vague term. We use it because that's what we've seen in the prior literature, but you're right, like value relevance, decision usefulness, these don't really tell you anything about the mechanism of what you're actually being useful for. So to be more precise, we believe that compensation costs can help you with forecasting the key determinants of valuation. So what we do in our papers, we look at sales growth and ROA, profitability. And so we're saying that by disaggregating the income statement a little bit, you can more accurately forecast future fundamentals. That's what we mean by decision usefulness. And then we show that it has some capital market implications as well. And so I agree with you. We can be a little bit more precise in our writing.
Thank you.
I have a quick comment about the usefulness. I think from investors' perspective, we really want to know whether certain employee or wages are variable cost versus fixed cost. So it's not just from 1 year of the income statement, but if you have a time series, right, investors are really concerned about during economic downturns in the industry or in the overall economy that costs are very sticky. And we usually can learn that about capitals investments, but we learn very little about human capital investment.
Yeah, that's exactly right. And that's exactly what we try to do in this paper. So our disaggregation is meant to separate intangible, variable, and fixed wages. So with that, let me actually move forward a little bit. Thank you, Ayung. So what we're trying to contribute to two main literatures. These traditional papers that you see that take an expense item and look at the value relevance of them, like R&D, advertising expense, SG&A, they traditionally focus on functional expenses. Now that's just natural because the FASB mandated disclosure focus on functional expenses. So that's what they have access to. One exception is there is a paper by Shiva and co-authors on stock options, which is more of a natural expense. But again, that's because the FASB mandates executive compensation disclosure. So our paper gets around these mandating issues by estimating the data item before the standard setters have actually mandated disclosure. This is similar to Eli Amir's paper on pensions, where he looks at pensions before the rule is fully passed. We also contribute to this burgeoning literature on the value relevance and asset pricing implications of firms' human capital. So on the asset pricing side, there are papers that show that human capital is a risk factor. And because of wage stickiness or labor operating leverage, like Ayung was referencing, that generates some non-diversifiable risk exposure. And due to that, you find some asset pricing implications. There's also some more on the mispricing side for employee satisfaction and turnover, and they find that those are relevant to fundamental performance and stock return performance. The paper that's most similar to ours is this paper by Rieger and Ruin. They look at personnel expenses, and they focus on the European setting because in IFRS, you are mandatorily required to disclose personnel expenses. There are two big differences, though, between our paper and their paper. One, we focus on US firms by using this new data set. And two, because we use this granular data set, we can disaggregate labor expenses by job type, by G&A, S&M, and R&D, which I'll talk about in a little bit. And this exactly gets to Ayung's point of disaggregating by fixed cost, variable cost, and intangible cost. And we can only do that because we have this very micro data, and they were unable to do that with the IFRS disclosures. So what are the empirical challenges here? Like I just said, measuring labor costs, especially when it's not required by the FASB, is difficult, especially trying to get any sort of disaggregation. The existing measures that exist in the literature, I think Sudipta was referencing this, there is some stuff in CompuStat that you can get. So CompuStat has a variable called XLR, which is total staff expense. So this is basically labor cost, aggregate labor cost. The problem here is that this is a voluntary disclosure for many firms, and only 20% of CompuStat has this variable filled in. And that too, there's significant selection bias here. So financial institutions have many regulatory bodies that control them. And so for other regulations, they have to disclose this information. And that's why they also disclose it in the 10K. Airlines and other unionized shops like FedEx and UPS, transport companies generally, they also disclose this information, and retailers also disclose it. So it's clearly not representative of the overall economy. It's these pockets of firms that disclose this information. So you don't have this wide cross-sectional coverage. Median pay was mandated in 2018, but now we have a wide cross-section, but we don't have a wide time series because it was only passed recently. And so what we found, the state of the art to get a wide cross-section and a wide time series, is this method by Donangelo et al., where they take the XLR data in CompuStat, they calculate industry year averages, and then they impute that to the full cross-section. Now you can imagine if there's selection bias here, and you're taking selected data and then extrapolating it, the errors can blow up very fast. And so what our goal is not to construct a perfect measure, but just to construct a measure that's incrementally useful to these existing measures, which are all imperfect in their own ways. So what we want is we want to cover a wide cross-section, cover a wide time series, like XLR Fill tries to do, but we want to capture more variation in expenses than XLR Fill can do right now. And we will validate this, this idea in the next coming slides. So what do? We use Revelio data. I'm sure many of you have heard of Revelio at this point. They create a universe of employees. So the data is at the employee level, and they construct a universe from LinkedIn resume. And then for each employee, they estimate the wage of that employee. They get true wage data from H-1B filings, from job postings, from Glassdoor, but obviously that doesn't cover every single employee that exists. So they do some algorithm to impute the wages for employees that don't have data. And then they classify each employee into 7 job types: administration, finance, operations, sales, marketing, engineering, and science. And what we do is we take those 7 job types and those employee wages, and we coarsen them to 3 categories: what we call sales and marketing, which is literally sales and marketing job types; R&D, which is engineering and science; and G&A, which is admin, finance, and operations. The reason we do this is we're trying to map our disaggregation into what we see as the traditional disaggregation you would see beyond COGS and SG&A. So here's an example of Salesforce's 10K, where they disaggregate operating expenses into R&D, S&M, and G&A. And so what Salesforce would be required to do according to the FASB proposal is they would need to show employee compensation for each of these categories, because on the face of the income statement, they disaggregate in this way. And so we use the motivation from the DICE proposal to try to map a similar disaggregation of wages within SG&A.
Kalash, Jen has a question.
Oh, yes, go ahead.
Aloha, Kalash. I'm not familiar with the Revelio data. I know some on LinkedIn, there are some fake profile. Some scammers kind of create a fake LinkedIn profile and they try to scam people. And I also know some employees, some people, even they are professionals, they do not have LinkedIn account. So how does Revelio address these kind of issues?
Yeah, it's a great point. I think this is why I was trying to emphasize earlier that our data will not be perfect. And you're bringing up some issues with fake accounts or maybe missing observations, but there's even issues with like selection bias, right? LinkedIn is a very white collar platform. And so we could be missing a lot of blue collar workers, which is why we don't have COGS wages as part of our study. So there are a lot of issues here with using LinkedIn data. All we're trying to do is, with this imperfect data set, can we find any sort of decision usefulness, predictive power, effect on the capital market? And if so, we feel that's a lower bound on the effectiveness of this disclosure, because with true mandated audited disclosures, you would imagine you would find even better results because the information would be more precise. So I agree with you. It's not perfect, but we feel that creates a lower bound to our effectiveness. Ayun?
Kalash, I think that Jung-Ho Choi from Stanford, who's visiting MIT now, he has a few papers using the Equal Employment Opportunity Employee Information Report, like EEO-1. And in that report, you have a more granular job title level headcount. So not just sales or cost of goods sold, it's actually like marketing managers, production managers. So the dollar amount you are reporting in the financial statements has 2 components. One is wage, the other one is the headcount, right?
Mm-hmm.
So I think as a reader, I want you to kind of like tell us the Revelio Labs data coverage relative to the actual headcount. So for sales managers, 60% of the headcounts are kind of like identified in this linking data, but for executive account managers, maybe 99%. So like readers in general would have an idea about what's omitted and what's actually included. Because you talk a lot about machine learning algorithm, everything is from the wage, which is the price for wage input, but that you don't have much validation on the quantity.
Yeah, that's a great point. So what we do on the quantity side is honestly quite naive. We know that Revelio doesn't have the full like every single employee in there. But what we implicitly assume is we assume that the distribution they do have in their data set between G&A, S&M, and R&D is reflective of the true distribution of the company, so that we can take the CompuStat employee count and break it up based on the Revelio distribution. And then that's how we get our aggregate wage expenses. So I can tell you the percentage of Revelio data relative to the CompuStat employee count, but I couldn't tell you the breakdown because implicit in our calculation, we're assuming that the distribution is like properly reflected. But yeah, so we should caveat that more explicitly if it's not clear already. So thank you for that.
Jim, do you want to unmute and ask your question? Jim?
But my question is what investors would care about when they read the income statement is if you have wage expenses or costs that are non-recurring, then that would be very worthwhile and relevant.
I agree. Yeah. So
you
you're
want to make a distinction between recurring and non-recurring.
And we try to do that by distinguishing between intangible investment type wages that are generating future value versus short-term variable costs that are just generating like immediate revenue versus fixed costs that are unrelated to immediate operations. We try to do that, and so I'll get into that now. But I agree with you. That's exactly what is necessary. You want to separate the economically distinct wages for forecasting purposes. And so we try to do that, and you can see our results, and you can let me know if you agree with what we're doing or if you have any thoughts. So to give you an idea of what our findings are, we first find that aggregate labor costs are value relevant. So they do seem to correlate with future fundamentals and prices. But the problem is that aggregating all of the wages together, like Jim is saying, it hides the economically distinct nature of these different types of labor. And so when we disaggregate that into these R&D, G&A, and S&M groups, we find that they correlate with fundamentals very differently. So sales and marketing correlates with short-term revenue growth and doesn't correlate with profitability. But R&D seems to correlate with long horizon revenue growth and depresses profitability. And G&A doesn't correlate with either. And then when we take this to the capital market results, we find that aggregate wages don't seem to correlate with future forecast errors or future earnings announcement returns. But disaggregated wages do. They do correlate with future forecast errors and future returns, earnings announcement returns. But they only do this when there isn't other information related to wages or expenses. And then we run some value relevance tests, and we show that the disaggregated wages have differing signs and magnitudes when correlating with future prices, which suggests that this disaggregation is useful because they have different relations with price. And then finally, we do some applications where we take existing metrics in the labor literature, and we see how our measure of wages can improve those measures. So the two applications we look at are we try to improve the measure of labor operating leverage and turnover rates using this wage data that we construct. So that's a very high level of the findings. Does anyone have any questions here before I move on to the sample? Okay. So I want to spend a few minutes talking about what the sample looks like. So we have these four measures of wages at the employee annual wage level. So in the figure A, we have the median pay data, which comes from Equilar. We have this voluntarily disclosed average wage data, which comes from XLR, which comes from CompuStat. We've got this lavender color, which is the Don Angelo measure, which fills it in by taking the voluntary disclosure and imputing it across the cross section. And then the blue line, the blue histogram is our Revelio data. And immediately what you can see here is that three of the distributions seem kind of related to each other. And then the XLR fill seems very different. And we think this is happening because you're taking the selected sample and extrapolating it to the whole cross-section. So you're kind of extrapolating these errors, and that's creating a very different distribution than the other three variables. So what we do is we drop that and we move on to looking at just log employee wages. The idea here is that employee wages are clearly log normal, they're right skewed. And so logging them, maybe we can get a clearer picture of what these distributions look like. And here you see that all three of the distributions seem kind of similar to each other. When we scale by revenue, you start to see that some differentiation between the three measures. You find that the median pay seems to be left skewed and the average pay seems to be right skewed. Now, this is obviously natural, right? Averages will be larger than medians if wages are right skewed. And so that's why the Equilar data and the CompuStat data are kind of diverging. And you find that Revelio is sitting in between the two of them. Now, what we think is happening here is there are a few errors that might be offsetting each other. Revelio is an average wage measure. So in theory, it should map exactly to the XLR data, assuming that the selection bias is not creating further right skew. But the problem is XLR is a fully loaded employee cost number. It includes fringe benefits like retirement benefits, health insurance, pensions, etc. Whereas Revelio is just capturing your base salary and some element of bonus, right? It's not capturing the fully loaded cost of the employer. And that's causing Revelio to be a little bit shifted to the left relative to XLR. And so finally, when we take the difference between XLR and Revelio, you can see that XLR is larger than Revelio very often, but the modal difference seems to be around 0. So we're not showing you all this to say that Revelio is perfect. Clearly, there are some errors here, but we want to give you some descriptive sense of how the Revelio data looks relative to the either voluntarily selected or short time series data we have from median pay or CompuStat.
Kalash,
yes.
Sudipta has a comment.
So you could look at disclosures around restructuring charges for employee severance costs. That would get you towards Jim's question.
That's interesting. Yeah, we can definitely do that. I know that I've looked at restructuring costs before, and it's not very filled in, but obviously that's going to be natural since it's restructuring doesn't occur for every firm. So I'll look at that subsample and see if I can extract some information. Thanks. And then quickly on the rest of the sample period, when we look at correlation, we find that with XLR, so with the voluntary CompuStat number, Revelio seems to have much higher correlations than the Donangelo industry imputation. And similarly, when we look at median employee pay, Revelio seems to have higher correlations than the Donangelo method. So this is providing some suggestive evidence that if we want these wide cross-sections, the Donangelo method may not be sufficient and the Revelio method may be a step in the right direction. Now, to validate this, what we do is we correlate these different wage measures with the portion of SG&A that we think is most related to labor. So SG&A, we all know it's a grab bag of a ton of stuff. It's a very heterogeneous grouping of expenses. And so we try to simplify that a little bit by pulling out measures that we don't think are strictly labor related. So we take SG&A and we subtract advertising and we subtract rental expense. We're unable to subtract anything else because things like R&D, stock comp, pensions, labor expense, they all have something to do with labor. And so we leave all of that in this adjusted SG&A number as our dependent variable. And we see how much explanatory power do these different wage measures have on this measure of adjusted SG&A. And what we find is XLR, which is voluntarily disclosed, has pretty high explanatory power, but it has a very small coverage that they don't cover nearly as many observations. The fill method has a very wide cross-sectional coverage, but the explanatory power becomes very, very weak. And Revelio kind of balances both of these where we get a wide cross-section and we get reasonable explanatory power. And we do this on levels. We do this scaled by revenue. We do this scaled by employees. And we get similar results that Revelio seems to be balancing these two priorities we have of wide cross-section with reasonable explanatory power. And so we use that as validation to suggest that this is a decent measure of wage expenses. Ayung?
So, Kalash, I appreciate that you have a lot of cross correlation kind of exercise in the previous table and on this slide. But I was wondering what is autocorrelation in each variables, right? If all of them capturing mostly fixed cost, then for empiricists or investors, we kind of have a firm fixed effect that captures most of the fixed cost, right? So for forecasting purposes, that is not kind of incremental, right, information. And then similar for XLR field, I think the industry fixed effect will capture most of it because it's actually extrapolated based on the industry. And then I believe that I think Revelio Labs machine learning is some sort of the industry within industry job title type of the fixed effect algorithm, right? If you have certain jobs, you all get the same wage. So can you explore a little bit more on autocorrelations and also what type of the effect dimension is going to actually explain the explanatory power for each variables you are considering here?
So we can definitely do that. And to reassure you, all of our actual tests, like tables 3 through N, have industry year fixed effect, have like lags included. So we've controlled for all of that. For this, I wanted to keep it very simple and just have a very simple univariate regression to see what the R squareds would be without the fixed effects. Because we see that once you include fixed effects, the R squares all kind of blow up towards 100%, and there wouldn't be much variation here across these numbers. I can show you these results qualitatively. You'll get the same conclusion, but the differences won't be as stark. But yes, I agree with you. And so the takeaway here is that Revelio does a decent job. It's not perfect, but it seems to get a wide cross section with decent explanatory power. Now to get to our actual results, we first want to look at once we've validated that wage expenses, this Revelio wage expense is a reasonable measure. We want to see how do they correlate with future revenue growth and future ROA, the two building blocks of valuation, growth and profitability. And we find that wages do seem to correlate with future revenue growth and future ROA. But what we claim is that this is hiding a lot of distinct natures of the different components that build up wage expenses. And so first we look at revenue growth. When we decompose wages into G&A, S&M, and R&D wages, we find that they have very different patterns with revenue growth. So first, we find that G&A, which is kind of a fixed cost, has no correlation with forward revenue growth. And this makes sense, right? The literal definition of fixed cost is that it doesn't vary with revenue. And so that's like very natural that that's what we would find. Sales and marketing, on the other hand, only correlates with revenue in the short run. And this makes sense if you think of sales and marketing as a variable cost. You hire salespeople and marketing people to generate revenue immediately into the future. So there's a 1 year, maybe a 2 year benefit, but then it goes away. And R&D, which is a more intangible long-term benefit, seems to provide a persistent increase in revenue growth. It does decay, but it seems to go out at least 5 years into the future. And so we find that these predictions differ for each component of wages. When we do this for profitability, we find similar effects. G&A and S&M don't seem to have any impact on ROA, whereas R&D seems to have a persistent negative impact on ROA. Now, that persistent negative impact could be the expensing of intangibles that should otherwise be capitalized. I know Stephen would disagree with that, but that could be something that's going on here. We try to adjust for this in the appendix by adjusting ROA, by adding back some intangibles, and we find that this negative coefficient goes away. So what seems to be happening is that it's helping on revenue growth, and it's hurting on this fully burdened ROA. But once you add back those intangibles, it seems to not affect ROA either. So taking stock of where we're at now, we find that, actually, just very quickly, to Young's point, we do control for industry year fixed effect, and we control for historical ROA, given that there's clear autocorrelation in profitability of companies and industry time varying economics. So we've shown that there's heterogeneous predictive power of these different wage components for both revenue growth and ROA, which suggests that there is some insight from disaggregating wages when trying to forecast future fundamentals. Now we want to look at capital market response. So far, we haven't gotten into this idea of, do people have this information or not, right? Because we've been correlating fundamental wage data on fundamental future ROA growth data. So there's no question on, do investors have this information or do they not? It's simply, is this information useful to forecast future fundamentals? Now we get into this joint hypothesis where we look, if investors don't have this information and it's useful, only then will it provide you some correlation to future forecast errors or future returns around earnings announcements. If either people already have the information or it's not useful, you're not going to find any correlation with future AFE or CARs. So it's a joint hypothesis here that we're doing. And what we're claiming is that the disaggregated wage data will provide correlations with AFE and CARs, especially when there's limited voluntary disclosure on information related to wages. And that voluntary disclosure would be either management guidance on expenses. So that would be guidance on both revenue and net income such that you can back out expenses, or literal wage information from the XLR variable and CompuStat. Ayung?
Yeah, can we go back to the one slide before? I think my comment is more about your right-hand side variable. Like I would like to see at least 3 different categories. If you can include the previous year's R&D wage, right? And then also the current year. And then the current year will be split into one-time item related to what Jim and Steve talk about, and also recurring item, right? So I think that kind of addressed the earlier point about under what circumstances, what kind of the firm years this information will be more useful. We will expect to see fixed cost, which is the last year's wage, is not going to be too useful if this year's wage actually the same as last year. But this year's incremental wage difference has to be recurring going forward to be relevant for forecasting evaluation decisions, but one-time items will not be relevant. So there's there's a nonlinear relationship in terms of horizon information in the wage information that if you can pinpoint that, and you can really kind of like advance this common letter discussion about when this information is going to be useful for investor evaluation. Yep.
Okay, we can do that. I mean, in some sense, what you're arguing is we should kind of flip this table where instead of going 5 years out on ROA, keep ROA fixed and include many lags of the X variables.
No, I think you don't need many lags. It's just that you fix the same table, but your right-hand side variable right now, each one will have 3 categories.
Okay, yeah. Previous year, current, recurring, current, fixed.
Yeah.
Okay, yeah, we can. The recurring versus fixed, we'll have to think about how to do because you're starting to split things because this is already an estimate, right? What we're doing here, and so you're splitting an estimate into 2 other estimates, and so you're starting to increase the noise. But previous year is like very easy to have. We can definitely do that. Yeah. Srinivas?
Srinivas.
Yeah, hi, Kalash. Wonderful paper. I just wanted to ask regarding these future projections, till how long it is able to predict. Do you have any idea, like say, till how long does it do that? I mean, for how many years is it able to predict it?
Yeah, so we went out 5 years. Obviously, every year you go forward, you lose some data. And so we don't have the longest time series to begin with because we can only go as far back as Revelio lets us, which I think is 2008. So we went out 5 years. I think I've run tests going out further and you just kind of keep seeing the decay. Maybe this is where Ayun's point of adding a lag would kind of show us when does it incrementally provide information. So maybe I can run that and see.
Yeah, something like an impulse response function or kind of maybe that ROA does it because the component of ROA which I was seeing, the magnitude has increased over years.
Yeah.
Does it kind of then, go down and stuff? Eventually, maybe, if it's a good R&D expense, it should show up somewhere maybe in the future.
Got it. Yeah, we can do that. We can do some DuPont decompositions as well to try to get at the mechanism. What is it actually impacting? We've done a little bit of that, but we wanted to keep it pretty simple just to validate this idea that it has some fundamental value. Because ultimately what we were trying to do is address these comment letter pushbacks that it has no value to investors. And we feel that the few tables we've already shown are enough to suggest that it does have value to investors, but we can go further.
Jain?
Could you go back to the previous slide?
Yes.
If you look at the coefficient on R&D wage, it seems the impact is increasing for, let's say, the F2 versus the F1. Yeah, in terms of the future ROA, it seems for the 2 years in the future, the result is stronger. Then it kind of plateau over there. I wonder whether this minus 0.034 and minus 0.029 Are they
Mhm.
significantly different? And why it's kind of like a plateaued?
Yeah,
for
my
the-
instinct is that they are not significantly different. Now remember, R&D wages is like kind of from 0 to 1, right? It's a percentage because it's scaled by revenue. And so what we're saying here is a 1 percentage point increase in R&D wage will impact ROA by 3 basis points, right? Not 3%. So, I mean, these are economically, they're meaningful, but they're small. And so the difference between 3 basis points and 3.5 basis points, yeah, I'll think about it. I mean, I can obviously run the test to show that if the difference is significant. But do you feel that this is an issue?
It's kind of like a little bit puzzling. It's also especially I say the later coefficient are kind of like almost the same.
Yeah.
It looks interesting to me.
Okay. Yeah, I can look more into it. I haven't looked into it, so yeah, I can do that. Thank you.
Thank you.
So now we move on to capital market tests. And so the idea here is we take future analyst forecast errors and we correlate it with current wage expenses. When we do this on the aggregate level, we find no correlation or insignificant correlation. And so what this tells you is, one, either everyone already has the wage expense data and therefore it's not going to affect future forecast errors, or two, it's not relevant, right? This is again that joint hypothesis issue I was bringing up earlier. So aggregate wages, yeah.
Kalash, Jim has a question about economic significance.
Yes.
Of your results.
On the ROA results?
Jim, is it about ROA results?
Yeah, I'm thinking about the ROA table there. Nowadays, they tell you that when you engage in these kind of regressions, you're going to have to assess economic significance. That's what reviewers tell people.
Yeah. So if you think about it,
I was wondering, I mean, one can, what's part of the problem here is one can go on endlessly what the controlling variables are all about. And the conclusion is ultimately going to depend upon what else you put on the right-hand side. So you start out and put in industry and fixed effects and whatever have you. And ultimately, all of these T statistics are going to vanish once you have enough on the right-hand side. So that leads to the question here is that in some sense, the T statistics and whatever have you is not going to be very reliable. So you can sort of try to turn that around by looking at limited kinds of correlations and then try to say here, this is economically significant.
Yeah, that's a great suggestion. We can do that.
Yeah, I mean, you can do that because then you're going to, you have to set it up in such a fashion that it's a plausible possibility that you will reject the null hypothesis and accept the null hypothesis, both.
Okay, yeah, I don't think these are large effects. They're not implausibly large, but I do think they're economically meaningful. But we'll introduce that flavor into the draft for the future.
It's going to be a challenge.
Yeah. Thank you, Jim. So we find that there.
Kalash, you have about 7 minutes left.
Yeah,
so
So let me speed through some of these results.
Interrupted from now.
I'll open it up if I feel like I make good progress. Thank you,
Okay, cool.
So we find that aggregate wages don't correlate with future forecast errors, regardless of the voluntary disclosure regime, regardless of whether there's expense guidance or not, or XLR disclosure or not. But when we go to disaggregation, you see that there are correlations with future forecast errors, but only in the samples where there isn't voluntary disclosure of related information. So the idea here is, for example, you look at fixed costs. Fixed costs seem to be related to smaller forecast errors. Now, the idea here is that there's past literature from Anderson et al. And Banker et al. That show that analysts assume that SG&A is quasi-fixed. And so what you see here is when that's true, when that's more true, so when SG&A is a bigger portion of total SG&A controlling for S&M and R&D, that ends up leading to smaller forecast errors because that assumption, that heuristic, is more accurate. But that's only the case when you're using the heuristic. When you have actual expense guidance, you don't need to use that heuristic, and therefore that correlation vanishes. Similarly, we know from Mary Bart's paper in 2001 that R&D, or companies that have high intangible expenses, are harder to process and forecast. And so when companies have more R&D wage investments or expenses, they're going to have larger forecast errors. But again, that's only the case when you're lacking this other information. And so this is suggested that this disaggregation is useful, but really it's only useful when you don't have other voluntary disclosure. And so that suggests we should have some sort of mandatory disclosure here for this kind of disaggregated information. We can do the same kind of study on the capital market side. Now you see some stars here, but to Jim's point, economically, these are very small. We're saying a 1 percentage point increase in wage expenses leads to, what is this, like a 1 or 2 basis point change in the earnings announcement return. So it's very economically not meaningful. But when you disaggregate, you do find larger effects by an order of magnitude, but again, only for the samples where there isn't voluntary expense or XLR disclosure. Now, I had a feeling I would run out of time. So those are the main results we want to show, that there is this prediction of future fundamentals, and this disaggregated information is useful for capital market outcomes like forecast errors or abnormal returns, but only when there isn't other voluntary information. We have some applications where we show you, now that we have this disaggregation, what can we do with it relative to the current literature? So there's this paper by Donangelo et al. That I've referenced a few times. They look at labor as a form of operating leverage, and they find that because it's a form of operating leverage, it creates risk that's non-diversifiable in firms. And so what we do is we construct this labor operating leverage measure only using fixed wages. So we segment out R&D wages and S&M wages. And we find that by virtue of being able to really precisely nail down the operating leverage component of wages, we can identify this effect that they've theoretically shown. And our measure seems to subsume other measures of operating leverage, both the labor share measure from Donangelo et al. And non-labor operating leverage. And so it seems like we are providing some sort of measurement improvement through specifically nailing down fixed labor costs. And this holds for the excluding microcap sample as well. Now, we also look at turnover rates. There's this 2022 RAST paper that uses the Revalue data to calculate turnover rates. And they find that turnover is negatively related to future ROA. The idea being that high turnover will hurt productivity, hurt like the flow of information within firms, and therefore cause negative impacts on ROA. So we replicate that finding, but then we further show that when you include a salary weighted turnover rate, that measure has an incremental positive effect. So the idea here is that yes, turnover hurts profitability, but if you're firing high cost workers and replacing them with low cost workers, maybe you can partially attenuate that negative effect. And so again, this is showing that the salary weighting, the salary information we're generating does have some incremental usefulness. And when we disaggregate, we find broadly consistent patterns across job type. So maybe you don't need to disaggregate for turnover because the results are kind of the same for all three components. So to conclude, we find that when we construct this measure of labor cost at the firm year level, it is decision useful. The aggregate measures are useful, but they hide the economically distinct nature of the different components. S&M only correlates with short-term growth as in a variable cost. R&D wages correlate with long horizon revenue growth, like an intangible investment, and depressed profitability because we expense the intangible investment. And aggregate wages don't seem to predict capital market outcomes like analyst forecast errors or earnings announcement returns, but disaggregated wages do, especially when we're missing voluntary information like expense guidance. And we demonstrate some applications on improving existing measures using these measures that we construct. And in ADP fashion, to give you some conclusions that are more policy oriented, we feel the FASB proposal is very effective and very appropriate at improving disclosure quality of the expense items, but we think you could go slightly farther. These rules will only be useful if you have the voluntary disaggregation on the face of the income statement, like Salesforce. But if you only report COGS and SG&A on the income statement, you're not going to be able to separate S&M and G&A and R&D. And in fact, this could counterintuitively reduce disclosure quality because you might see a company like Salesforce coarsen the income statement to avoid disclosing disaggregated labor costs. So our recommendation is the FASB should prevent the strategic coarsening by mandating companies maintain whatever existing levels of disaggregation they have on the income statement. This may be unnecessary if disclosure choices are sticky, but they could also mandate that G&A, S&M, and R&D are required to be disclosed and disaggregated. So we feel that this paper shows that there are benefits for capital markets from these labor cost disaggregations, and we attempt to provide some ex-ante support to help the FASB's evolving proposal. Thank you, everyone. And then lastly, mark your calendars. In 2 weeks, there's another ADP session by Federico on restandardized financial statement data.
Thank you, Kalash, for your presentation. So I know now we are out of time, but there are a few comments.